Jason bought his first home at 28 years old, not because his income suddenly exploded, not because he discovered some brilliant financial insight, but because, according to everyone around him, that was what responsible adults were supposed to do. He had done what people praise as the hard part. He saved diligently for years and managed to put together $42,000 for a down payment. He was tired of sending a rent check every month and hearing the same phrase repeated like a financial law of nature: renting is throwing money away. His parents asked when he would finally stop renting and start building equity. Friends his age were posting photos of new houses, keys in hand, smiling as if they had crossed an invisible line into adulthood. The message was subtle but constant. Owning a home means you're moving forward. Renting means you're stuck. So Jason bought a house. The price was $420,000, located in a Denver suburb. Not a dream home, not a luxury property, just a sensible house in a good area, the kind people say is perfect for someone building a future. He put down 10% and financed the rest at a 6.8% interest rate. When Jason signed the paperwork, he didn't feel anxious, he felt proud. This didn't feel like spending money, it felt like investing in himself. In his mind, every monthly payment was moving him forward. Every check was turning rent into ownership. He believed he had escaped the trap of wasting money and entered the world of wealth building. But there was one critical thing Jason never did. He never ran the numbers. He didn't calculate the full cost of ownership. He didn't compare buying to renting and investing the difference. He didn't ask the most important question of all: what happens if I don't buy? Because society had already answered that question for him, and society's answer sounded confident enough that Jason never thought to challenge it. That assumption, the idea that buying is automatically smarter than renting, is where everything begins to go wrong. Once the excitement of buying faded, the numbers began to settle in. Jason's mortgage payment alone was $2,470 per month, but the mortgage was only the beginning. On top of that came property taxes, $420 per month, homeowner's insurance, $180 per month, HOA fees, $215 per month. When everything was added together, Jason's total monthly housing cost came out to $3,285. That number mattered more than he realized. Before buying, Jason had been renting a clean, comfortable two-bedroom apartment for $1,900 per month. It was closer to his office, required no maintenance, and came with zero surprise expenses. By buying the house, Jason increased his monthly housing cost by $1,385. But here's the key problem. Jason never framed it that way. He didn't see a $1,385 increase in expenses. He told himself he was paying himself instead of a landlord. That belief made the higher cost feel justified, even responsible. This is where the cultural narrative does its most dangerous work. People are taught to focus on rent versus mortgage, not rent versus total cost of ownership. The mortgage feels productive, the other costs fade into the background. But property taxes don't build equity. Insurance doesn't build equity. HOA fees don't build equity. That money is gone forever, just as completely as rent. Jason didn't question this because no one around him ever questioned it either. Every conversation about housing stopped at one sentence: at least you're building equity. What no one told him was that most of his monthly payment wasn't doing that at all. Over 4 years, Jason spent approximately $157,000 on housing costs. That money didn't vanish dramatically. It disappeared quietly, month by month, disguised as progress. Meanwhile, the housing market cooled. The home that Jason bought for $420,000 was now worth about $445,000, a small increase on paper, but far less impressive once inflation and time were taken into account. His remaining mortgage balance was $352,000. On paper, Jason appeared to have $93,000 in equity, and to Jason, that number felt like proof that buying had worked. But this is where the illusion begins to crack. Because equity only tells you what happened inside one decision. It tells you nothing about whether that decision was better than the alternative. And Jason never compared it to the alternative. This is the step almost no one takes when buying a home. Jason looked at his equity and assumed he was ahead, but he never asked the most important question in personal finance. Ahead compared to what? To answer that, you have to compare buying not to renting emotionally, but to renting plus investing the difference. If Jason had continued renting at $1,900 per month, he would have avoided the extra $1,385 he was now spending each month as a homeowner. That money didn't disappear into thin air. It was money that could have been invested. If Jason had invested that monthly difference into a simple index fund earning an average 8% annual return, something very different would have happened. Over 4 years, those monthly investments would have grown to approximately $81,000. But that's only half of the comparison. Jason also tied up $42,000 in a down payment. That money didn't vanish, but it stopped working efficiently. If that same $42,000 had been invested in the market at the same 8% return, it would have grown to roughly $57,000 over the same period. Add those two numbers together, monthly investments, approximately $81,000, growth of the original down payment, approximately $57,000. Jason's total liquid net worth would have been around $138,000. Now compare that to his actual situation. Jason's home equity was about $93,000. On paper, he owned something. In reality, he was $45,000 poorer than he would have been if he had simply kept renting and invested the difference. And there was another critical distinction. That $138,000 would have been liquid, accessible, flexible. Jason's $93,000 in equity was trapped. To use it, he would have to sell the house or borrow against it. Both options come with costs, risk, and loss of flexibility. This is where the comforting story collapses. Jason didn't build wealth by buying his home. He destroyed it compared to the alternative. And the most painful part is this. Jason still believed he had made a smart financial decision. Why? Because no one ever showed him the math. He followed the narrative instead of the numbers. And once you believe the narrative, the loss stays invisible. At this point, the story stops being about Jason and starts being about the framework that explains why his outcome was not unusual. The problem was never that Jason made a reckless decision. The problem was that he made a common one without a proper model. This is where the 5% rule comes in. The 5% rule is a simple way to estimate the true annual cost of owning a home, the portion of your housing costs that does not build wealth and can never be recovered. Most people think of home ownership in one dimension, the mortgage. But ownership has multiple costs, and several of them quietly drain money every year. The first is property taxes. Property taxes do not reduce your loan balance. They do not increase your equity. They are simply a fee for occupying the property. In most areas, property taxes average around 1% of the home's value per year. The second cost is maintenance and repairs. Homes deteriorate constantly. Roofs age, HVAC systems fail, appliances break, foundations shift. Even in a well-maintained house, upkeep typically averages another 1% of the home's value per year over time. Some years you spend very little. Other years you write 5-figure checks. The third and least understood cost is the cost of capital. If you borrowed money, this shows up as mortgage interest. If you paid cash or made a large down payment, it shows up as opportunity cost, the return your money could have earned elsewhere. When you blend mortgage interest rates and foregone investment returns together, this cost averages about 3% of the home's value per year. Add the three components together: 1% property taxes, 1% maintenance, 3% cost of capital. You get 5%. That 5% is the money you are effectively throwing away each year as a homeowner, not because owning is bad, but because housing is not free. It is the annual price you pay to live in that house. And here is the key insight. That 5% vanishes just as completely as rent does.